In today's video, I'll be covering the Fed pivot and its implications for the stock markets, which many investors seem to misunderstand. I'll be shedding light on the actions the Federal Reserve plans to take in their upcoming meeting, their approach towards interest rates in the next 6 to 12 months, and the anticipated impact on the stock markets. Additionally, I'll share a potentially profitable investment opportunity based on this analysis. This is a very important video. Before we dive in, let me provide a quick update with the graph showcasing the Federal Reserve's interest rates over the past 18 months. The Federal Reserve kept interest rates at 0% until they observed a surge in inflation. And as time passed, they came to the realization that this inflationary surge was not a temporary and started to raise the rates. Starting in March of 2022, the Federal Reserve initiated a series of interest rate hikes. It began with a 0.25% increase, followed by a 0.5% rise in May. As inflation persisted and accelerated in June, the Fed grew concerned and raised the rate by 0.75%. This pattern was repeated in July, September, and November. In December, the pace of rate hikes slowed, but they still implemented a 0.50% increase. On February 1st, there was another 0.25% raise, and during their recent FOMC meeting, they increased it once more by 0.25%. All this information is publicly available on the Federal Reserve's website. Due to these recent rate hikes, the interest rate has risen to 5.25%, a significant jump from its previous 0% level. As a result, mortgage interest rates have surged from 3% at the start of last year to 7 to 8% currently. This has led to declines in the stock and crypto markets, as well as inverted yields in the bond market. While quantitative tightening has also contributed to these developments, we will explore that aspect further later on. The Federal Reserve has outlined its plan, known as the Fed pivot, which involves a four-step sequence. Step 1. Slowing down interest rate hikes. During Step 1, the Federal Reserve aims to reduce the pace of interest rate increases by implementing smaller increments. This process has already begun, with recent rate hikes ranging from 0.75% to 0.25%. Step 2. Pausing interest rate hikes. In this phase, the Federal Reserve will halt interest rate increases altogether. Step 3. Lowering interest rates. This phase involves the Federal Reserve starting to lower interest rates again. Step 4. Quantitative easing involves the Federal Reserve resuming the process of injecting money into the economy. Currently, we are in stage 1 of the pivot, where the Federal Reserve is gradually slowing down interest rate hikes. Jerome Powell, during the most recent meeting, indicated that rate cuts are not expected to occur this year. The Fed will only proceed to stage 4 if there are significant economic issues. It's important to note that the stock market rally typically occurs after stage 4, not during it. Understanding the timing of each stage is crucial to maximizing gains. And with that rally, we are going to see a lot of new millionaires. So, it's better to understand what's currently happening and enter at the exact point to get the maximum gains. This is called the lag effect. You can check the history of the previous recessions. If you want to know more about the Fed pivot, over the past 6 decades, historical data shows that whenever the Federal Reserve pauses interest rate hikes, the stock market tends to rise by an average of 6% within 2 to 3 months. However, when the Federal Reserve cuts interest rates, the stock market has hit new lows in the economic cycle in 7 out of 9 instances. On average, the stock market has experienced a decline of 23% during those times. The only exceptions were in 1989 and 1995, when inflation remained around 2 to 3% and the economy was performing well, resulting in no significant stock market downturn. To put it simply, if the Federal Reserve chooses to pause interest rate hikes later this year, there's a likelihood that the stock market may increase by approximately 6%. However, in a scenario of high inflation, the Federal Reserve might need to maintain higher interest rates for an extended period, potentially slowing down economic growth, causing a decline in corporate profits, and putting downward pressure on the stock market. It's essential to consider the current economic landscape, where GDP is trending downward and inflation is above 3%. Analyzing yield curves can provide insights into forward sentiments. Unlike in 1989 and 1995, when yield curves were normal, they are currently inverted, signaling a more complex economic situation. It is essential to understand this 4-step sequence in detail and how it will impact the stock market, and many people are misunderstanding the situation. The Federal Reserve has already taken steps in this direction by slowing down its interest rate hikes after implementing 4 consecutive increases, each at 0.75%. Although the Fed paused its rate hikes during the June meeting, it raised rates by 0.25% again during their recent meeting and hinted at further rate increases. This suggests that the recent rate hike might not be the final one during the current economic cycle. At some stage, the Federal Reserve will need to ease the pace of rate hikes. Their aim is to achieve a 2% inflation rate, with Jerome Powell mentioned he wants to look at core inflation. Currently, core inflation stands at 4.83%. As for inflation, it was at 9.1% last June, decreased to 7.7% in October, and reached 5% this March. While it remains uncertain if inflation peaked in June, I hold the belief that it was the highest point in this economic cycle. Furthermore, Jerome Powell hinted that there might be another interest rate hike at the next meeting on September 20th. The current rate stands at 5.25%. The next two scheduled meetings are on September 20th and November 1st. It is widely expected that the Fed will implement a 0.25% interest rate increase in September, followed by a potential pause in November. Once we receive the data, I will update you accordingly. The impact of Federal Reserve interest rate hikes on the economy is not immediate due to a lag effect. Even if they were to halt the rate increases now, the economy would still experience the repercussions. Consequently, consumer spending has become more cautious, leading to expectations that inflation will not surge beyond the levels observed in June 2022. This is especially true considering the projected worsening of the economy. While energy prices are anticipated to rise, it is unlikely to cause a significant surge in inflation. However, if inflation were to increase at a higher pace, the Federal Reserve would be compelled to continue raising rates incrementally by 0.25%. Let's discuss the rest of 2023. So far, the Fed's implementation of Step 1 in its pivot hasn't triggered a sustained stock market rally. While there were a few short-lived dead cat bounces, they failed to make a lasting impact. The Federal Reserve intends to keep interest rates high for an unspecified duration, leaving us in the dark about when they'll ease the restrictions. Their statements have been rather vague, and despite claiming to be data dependent, they haven't provided a clear timeline for rate adjustments. According to the Fed's forecast, they expect inflation to drop to 3% by the year's end, and they anticipate reaching their targeted goal of 2% inflation by 2024. However, with the ever-changing economic landscape, these projections are subject to adjustments and uncertainties. The path to achieving the target goals appears to be a challenging one, with Jerome Powell expressing doubts about a soft landing, indicating a higher likelihood of a crash landing. Economic conditions are expected to worsen, with various sources predicting a high probability of a recession. The Conference Board, Ned Davis Research, and the Bloomberg model predict recession chances at 96%, 98%, and 100%, respectively. Moreover, many CEOs share a pessimistic outlook, with an 85% expectation of a recession. During a recession, companies listed in the stock market tend to see a decline in profits, leading to a revaluation of stocks at lower prices. On top of the looming recession and declining corporate profits, it's crucial to anticipate further quantitative tightening by the Federal Reserve. This entails reducing the money supply in the economy after injecting a substantial amount of money. If you want to know more about the Fed's quantitative tightening, I'm uploading a detailed video that provides monthly updates on how much money the Fed is withdrawing. The most recent video covers the period until July 2023, and I encourage you to watch it as it contains crucial information for investors. The Federal Reserve is adopting a more serious approach to tightening, choosing a better alternative to massive money printing. However, this tightening isn't favorable for the stock markets, as they thrive on easy money. Since September, the Fed has ramped up the quantitative tightening. I have focused on data from September onwards because that's when the maximum allowable quantitative tightening was raised from $47.5 billion to $95 billion. Consequently, the next 12 months are expected to be a challenging year for the stock markets. With high interest rates, worsening recession, rising unemployment rates, decreasing corporate profits, and quantitative tightening reducing available money, there seem to be few positive catalysts for the stock market in 2023. If you're hoping for a rally based on the Federal Reserve pivot, it's essential to exercise caution and avoid being deceived. The Fed pivot involves 4 steps, and any rally during the initial or second step is likely to be a dead cat bounce, meaning it won't be sustainable in the long run. Regarding Step 3 of the Fed pivot, when interest rates are cut and money is printed, some may anticipate a stock market surge. However, it's crucial to approach this with caution and be careful. It's worth noting that a sustainable stock market rally will occur after Step 3 of the Fed pivot, but it won't happen immediately. Historical patterns indicate that it's not a matter of announcing an interest rate cut and the market immediately taking off. After the Federal Reserve implements interest rate cuts and quantitative easing, the stock market usually experiences a forward decline. This action is taken by the Fed in response to significant issues like the Great Financial Crisis or the pandemic. As a result, the market's recovery is delayed as the underlying problem persists. Given this scenario, it is crucial to approach the stock market with caution, whether you are a trader or an investor. The opportune time to enter the market may be after phase 3 of the pivot. Waiting for a period of panic and selling, known as disaster capitalism, can be a prudent strategy. During such times, commodities often perform well. Currently, the strong US dollar is impacting commodities negatively. However, after the Fed completes step 3 of its pivot, commodities, especially silver, are expected to experience a significant surge. Silver is poised to benefit from quantitative easing and a weakened dollar. Additionally, its importance in the green revolution, essential for electric vehicles, solar panels, and other applications, further contributes to its potential rise. It's worth noting that easily accessible silver has already been depleted, leading to supply and demand imbalances going forward. As for my personal prediction and approach, please bear in mind that this is solely my view, and it's essential to conduct your own research. I do not intend to sell my investments, as panic selling is typically unwise. Weathering the storm and waiting for the right moment to enter the market is my strategy. I diligently monitor crucial data such as Federal Reserve's quantitative tightening, CPI, PC numbers, reverse repo market, unemployment rate, and GDP. All this information is publicly available, so it's essential to utilize the free resources to make informed decisions. There might be a few dead cat bounces during the current economic cycle, so avoiding the fear of missing out and practicing patience is crucial. That's it for today, and I hope that's helpful. Please subscribe. Thanks for watching. Until next time.